Yes, students, it's a great time we meet again for a session of financial accounting. So today I want to do on how statements of sole traders are prepared. So this is a topic in the financial accounting, and remember financial accounting is covered in many areas in the accounting field. So to be more specific, I will do a question of May 2017 from the CPA course. That is the course which is offered by CASNEP. So basing my argument on the CPA, I would be able to cover most of the courses, because now CPA seems to be a bit deeper than the other courses in terms of a matter of accounting. So let us look at the question of May 2017, that is financial accounting from the CPA course, which is offered by CASNEP here in Kenya. So the question, they were saying that the foreign trial balance was extracted from the books of Choice Mero as at 30th April 2017. So you are given a trial balance, then you are given additional information, whereby additional information number one, they say that allowance for doubtful debt is to be increased to 5 million. Remember that for the allowance and doubtful debt, for us to record it in our relevant statement, that is more so in the income statement, and at the same time, remember it will affect the debtors balances, but to start talking about when recording it in the income statement, remember that it will affect our expenses, so it will be recorded as an expense, of which we always record an increase as an expense, a decrease as an income. Like now, if you check in the trial balance, you were given allowance for doubtful debt of 3,500. We were provided with allowance for doubtful debt of 3,500. Then in the additional information, they said that it increased to 5,000. So which means that the increase of 1,500, this is an expense. This is an expense. So for the allowance for doubtful debt, we check increase or decrease. Increase or decrease. So an increase being an expense, an increase being an expense, a decrease being an income. A decrease being an income. So this 5,000, it increased to, will be deducted. So you deduct it from the debtors balances. Deduct it from the debtors balances. You deduct it from the debtors balances. Because now, the allowance for doubtful debt, this is all about an amount which would be set aside to cater for what they doubt that might not be received. So they had already set 3,500, of which the amount was increased to 5,000. So this is an amount set aside to cater for what you doubt you might not recover from your debtors. So it's like a provision. So which means that is, if you increase the amount, that is an expense. If you decrease the amount, that is an income, of which the total amount you increase to will be deducted from the receivables, which is the same as the debtors. So number two, they say rates due as at 30th April 2017 amounted to 500,000. So remember that our financial year was ending 30th April 2017. So there was some rates which were due by that time. So which means those are outstanding amounts. So the outstanding balances. So those are the outstanding balances. So outstanding balances, remember these are all about current liabilities. These are the current liabilities. And remember you have to increase those outstanding balances in the relevant expenses. So right now you have to check the rates in the trial balance in the TB, so that we add this amount before we record our rates in the income statement as an expense. So the next thing they are talking about is inventory as at 30th April 2017 was valued at 52 million. So that is closing inventory. Number 4, drawings amounting to 10 million have been debited to the capital account. So that one has already been done. Depreciation is to be charged on cost as follows. So which means that when they say that depreciation is to be charged on cost, so that is a straight line method. So that is a straight line method whereby you take the value of the relevant assets, that is building and equipment, you just multiply with these depreciation rates which you are provided in order to determine the depreciation for that relevant year. Insurance amounting to 200,000, rates to the year ending 30th April 2018. So that is now an expense which has been paid in advance. So that is a prepaid expense. That is an expense for the next financial year which has been already paid. So prepayments are assets. Prepayments are current assets. So prepayments, these are current assets. These are current assets. So of which, when recording the relevant expense, like now the insurance, when I will be recording insurance in the income statement as an expense, I have to do what? I have to deduct the prepaid expenses. I have to deduct the prepaid expenses. Like now here, our prepayment was concerning insurance. So I have to check the relevant insurance, which was prepaid. So remember that I've said the prepayment is insurance. So I have to check the relevant insurance in the trial balance. I deduct that prepayment before I record the relevant insurance under the income statement as an expense. So that was the 6 additional informations which were provided there. So the first thing which you are required to do, here is all about to do an income statement and to do the statement of financial position. So let us start from the income statement, then we do the statement of financial position for the choice mirror. So here we have a choice mirror. So we have income statement. They need an income statement. So that is for the year. So for the year ended 30th April 2017. 30th April 2017. So 30th April 2017. So 30th April 2017. So remember here now, we start from sales. So we start from sales. So if we check sales, so sales is 229,950. So after sales, there's return inwards. So there's return inwards. So remember that once you made a sale, then some goods were returned. So some goods were returned. So 1550. So we have to deduct that so that we get the net sales. Then after that, we need to raise the cost of sales. So the cost of sales here, we start from the opening inventory. Inventory given in the trial balance, 50,000. So remember that this one is in terms of thousands. So we have 50,000. We add purchases. So the purchases which are provided here, so we need to check the purchases, 170,020. We raise return outwards. Remember that if you purchased, then you returned. Return outwards. So was there return outwards? So if we check from our trial balance, return outwards of 4,600. It's there in the trial balance. So opening stock plus purchases, we raise return outwards. Then we raise the closing inventory. We raise the closing stock. So the closing stock was there in the additional information number 3, 52,000. The 52,000. So the answer we get here is what we subtract from our net sales so that we get the gross profit. After gross profit, I can add some incomes here. So if I check some incomes in the trial balance, I have the discount received. I have the discount received. So the discount received of 4,600. Then we have to raise expenses. So for the expenses, I can start from the additional information. So my additional information, we have increase in allowance for doubtful debt, increase in allowance for doubtful debt. You know that it was 1,500. I talked about it. We have in the trial balance, we have what we call rates and insurance. Because checking in the additional information, I can see additional information number 2. There was rate which was due, that is outstanding, which needs to be added. Then note 6, there was insurance, which was prepaid, which needs to be deducted. So remember that our relevant rates and insurance from the trial balance is 4,000. So we take 4,000. We add the rate, which is outstanding. Then we minus the insurance, which is note 6, which is prepaid. So other expenses include like notes, because note 3 is inventory, note 4 is all about drawings. Note 5, we have depreciation. We can talk about depreciation. So depreciation on building. We have depreciation on building. That is 5%. Remember, it was based on cost. That is on straight line method. So if it's on reducing, we have to deduct accumulated depreciation first, and then multiply with the rate. But you were told that it was based on cost. So which means that is a straight line method, which we will take the percentage, we multiply with the cost of the assets. So the building, the figure for the building from our trial balance is building. So I can see equipment. Building. So the building is 50,000. So the building is there, 50,000. So this is 50,000. So then we have equipment. So equipment at what percentage? 10% times. So the equipment is at 5,000. Yeah. So we are done with the additional information. That is how you are supposed to do. So for you to record your expenses well, it's better you finish with the additional information, then you embark on the trial balance on the expenses which you might have not recorded. So checking on the trial balance, we have expenses like sundry expenses. So the sundry expenses. So the sundry expenses, that is 840. So 840. We have stationery. We have the stationery. So the stationery is 1640. We have the Rigo. We have the Rigo fees. So which is 280. We have, remember for allowance and doubtful debt, I said we record the increase or decrease in the income statement. Increase being an expense, decrease being an income. So we have salaries. So I'm recording what we have not recorded from. The trial balance. So I can see selling and distribution. Cost. So the selling and distribution cost 1600. We have discount allowed. So for the discount allowed, we have a 6300. So up to that point, we are done with the expenses. So I can use my calculator now to compute what I have not computed in order to get the net profit or loss. So to check for the net profit or loss, so 229,950 minus 1550. So this is 228,400. So 228,400. So 50,000 plus 170,020 minus 4,600 minus 52,000. So this is 163,420. So if you check 228,400 minus the answer, 228,400 minus 163,420. So this is 64,980. So here to get the total incomes, remember I was to add this income of the discount received plus 4,600. So I have 69,580. So if I take 4,000 plus 500 minus 200. So this is 43. Then this is 50. Then this is, so 50,000 times 0.05. This is 2,500. So we have 1,500 plus 4,300 plus 2,500 plus 50 plus 840 plus 1,640 plus 280 plus 39 plus 1,600 plus 6,300. So this is 58,010. So we need to minus from 69,580 minus the answer. So this is a net profit of 11,570. So now we can be able to do the statement of financial position. So choice mero. So we have the statement of financial position. Position as at. So our financial year was ending 30th April 2017. So we start from non-current assets. So we start from the non-current assets for our question. So for the non-current assets, remember that we have a building. So this building, even we have it from our expenses. So the value of the building was 50,000, but I have to deduct accumulated depreciation which was given 11,400 minus the depreciation for the year. So this is accumulated depreciation and this is depreciation for the year, for you to get net book value. Then for the equipment, it was 500. So the equipment was 5,000. So we did a mistake here. So this is 5,000. So which means that I have to change my values for the expenses. So 0.1 times 5,000. So this one is supposed to be 500. So which means that my expenses, I have to change them a bit. So we picked 500 instead of saying 5,000. So this one is a 58,460. It's the same as I could have added. I could have added 450 here. Because now we eliminated that. So 58. So this one was supposed to be 58,460. So the 58,460 minus, so 69,580 minus the answer. So this one was supposed to be 11,120. So that is just a short mistake we did here. Instead of picking 5,000, we picked 500. So from there we can continue. So I'm supposed to minus here the accumulated one, which is 1770 minus the 500. Accumulated depreciation minus depreciation for the year. So after that, we can go to the current assets. We can move to the current assets. So this one can be done on this side. So the current assets, obviously we start from inventory, the closing one, that is inventory at the end of the year, the closing inventory, which is 52,000, but this is shillings in thousands, and here we have shillings in thousands. Then we come to the trade receivables. So for the trade receivables, you have to take 36,000 minus the 5,000. The allowance, which was increased from 35 to 5,000. So I have to deduct the 5,000. Then after that, we have to check things like cash in hand, bank balance, prepayments. So those are the current assets. So we have cash in hand. So we have cash in hand of 13,400. We have bank balance. So we have the bank balance of 32,660. So that is okay. So cash in hand and bank balance. Then we have a prepaid insurance. So that is according to note 6. So 200. So up to that point, we have total assets. We have the total assets. Then we have to check on capital and liabilities. So capital and liabilities. So for the capital, 116,800. So we have 116,800. Add net profit, add the profit from the income statement, 11,120. So if there was drawings, we have to raise. If there was drawings, but I cannot see if there's any drawings. There is nothing. So non-current liabilities, long-term liabilities, I can check if they are present because we have inventory purchases, return outwards, cash in hand, bank balance, building, sundry, stationery, legal, allowance, trade receivables and payables, salaries, capitals, and there's nothing like long-term liabilities. Remember that long-term liabilities, these are liabilities which are supposed to be settled for 12 months. So the one which are for months. So let's move to the current liabilities. So for the current liabilities, we have the trade payables. We have the trade payables. So for the trade payables, we have 39,670, and we have outstanding balances. So the owings. So the outstanding, that is outstanding balances. So to be more specific, it was rates. So that is according to additional information number 2. So the 500. So up to that point, we can check if there is no another item before we say total. The total equity and liabilities. Equity and liabilities. So let us check if the question is balancing or if there is anything which is missing. So we have 50,000 minus 11,400 minus 2,500. So this is 36,100. 5,000 minus 1,770 minus 500. So this is 27,30. So if I say if I add assets plus 52,000, so this is 31,000, so plus 31,000 plus 13,400 plus 32,660 plus 200. So this is 168,090. So 116,800 plus 11,120 plus 39,670 plus 500. So this is 168,090. So that is how you were supposed to do this question of a sole trader. And that is how financial accounting is easier. So this is your tutor, CPA Dunochoy, who does a lot of sessions in accounting. That is more specific, financial reporting, that is advanced financial reporting. You can see this is sessions for financial accounting also. I would be uploading to your YouTube. And at the same time, I do live Zoom sessions, which you can attend. So subscribe to my YouTube channel, and thank you for your time. And at the same time, you can share this video to all platforms, because now I know financial accounting is done in all levels, in most of the courses, like now in the Bachelor of Commerce and in many other courses. So thank you for your time, and share the video. And at the same time, for the guys doing financial accounting as a unit with the CPA, with another course, if you need assistance, you can be able to reach me through the number 0728 760 546, or you check in my social platforms, CPA Dunochoy. We can be able to chat on the way forward.